Today is Monday, December 15th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, Mark Bowman, and J.P. Steiner, all from the ADMIS Research Team. Starting with the grains this morning, Mark Soderberg, as we move toward the holidays, what will drive prices across the ag space this week?
Well, with no major USDA reports now until early next year, markets will just continue to focus on South American weather along with usage figures, which obviously would, of course, include Chinese purchases of U.S. soybeans. Today's delayed export sales data from the week ended November 20th finally showed some big sales to China at nearly 2.15 million metric tons. That equates to about 78 million bushels. So between the sales and announced flash sales in recent weeks, known sales to China have now reached 4.3 million metric tons. Many in the trade feel that with some smaller sales and other sales announced to unknown buyers, that actual Chinese purchases may be in a range of 7 to 7.5 million metric tons. So we're getting closer to that 12 million metric tons the Trump administration has indicated China has agreed to purchase for the 25-26 marketing year. But despite these Chinese purchases, overall commitments are, as of November 20th, they're still running 38% below year ago. USDA forecast is only down 13%. The last week, the USDA chose to punt on keeping the U.S. bean export forecast steady at 1.635 billion bushels, which I think is at least 50 to 100 million bushels too high. Other usage data, we've got NOPA crush figures coming out here a little bit later this morning. NOPA members are expected to have processed about 220 million bushels last month in November. That would be down 3% from October's all-time high at 228 million bushels, but the second highest figure ever. So while exports remain weak, I'm of the opinion the crush forecast from the USDA is probably at least 20 to 40 million bushels too low. Weather-wise, South America, mostly favorable. Plantings in Brazil are largely done now. AgRoel today reported 97% done there. So I think as we move along, weather and rains in Brazil have been very timely here in recent weeks. So I look for record or near record yields driving production up to 180 million metric tons or higher. The USDA right now is at 175. But the jury's still out in Argentina, southwestern third, maybe half of the growing area there has turned dry as of late. So we're definitely going to need to see some rains by early part of January to avoid some crop-threatening stress. So while China has returned as a U.S. buyer, prospects for another year of record production in South America is starting to weigh on prices as speculators are really starting to shed some length here on both corn and soybeans.
Mike, talk about speculator traders. Will they impact trade as we wind down 2025?
Yeah, I think so. This delayed data from the CFTC has showed that speculative buying has been much bigger across the ag space in this late October, early half of November timeframe, much more than originally thought. Friday CFTC data got us up to positioning as of November 18th. Over a 5-week period, the money managers flipped what was a net short position in the ag space of 292,000 contracts to net long 365,000 contracts. You look at specific markets in soybeans. During this 5-week stretch, money managers bought 230,000 contracts. That's the most ever over a 5-week period. Similar situation in meal, 182,000 contracts, the most ever over a 5-week stretch. We've also seen the money managers flip what was a pretty heavy short position in corn at 191,000 to net long almost 40,000. So big buying there. So with weather in South America, mostly favorable, demand decent, but not spectacular. I think it's just going to continue to kind of see some slow easing here. Speculative selling into year end, kind of allowing prices to move sideways to lower.
Thank you. Various central bank meetings this week. JP, what should we expect from these?
So we've got central bank meetings from the European Central Bank, the Bank of England, and also the Bank of Japan this week, and they are all expected to do different things. On Thursday, the ECB will announce its policy decision. The bank is widely expected to keep policy rates steady at 2%, where it could remain for all of 2026. Inflation in the Eurozone has reached and stayed around the bank's 2% target and is also not expected to deviate much. Growth in the country, too, has proven resilient as well. However, there has been some speculation growing that the next move from the central bank could actually be a rate hike. Money markets are implying a 29% chance of a rate hike in December 2026. This comes after a European Central Bank board member, Schnabel, said that the next move out of the central bank may actually be a rate hike rather than a rate cut, contrary to what most have expected. The euro has strengthened strongly against the dollar this year, which in turn has had a disinflationary effect on prices and has caused some concern that if the euro continues to strengthen, the bank may need to lower rates below 2% to keep inflation at its 2% target, although this is still a drawn-out scenario. Also on Thursday, the Bank of England's policy meeting, where the bank will announce its policy decision, that the bank is expected to lower rates by 25 basis points now that November's budget is out of the way, and has also relieved some uncertainty about its potential effects on the economy. Despite stagnant growth in the country, inflation is still above the bank's 2% target at 3.6%, so nearly twice the target. Though the bank is still expected to lower rates, although in an expected tight vote. The governor there, Andrew Bailey, is likely to be to cast the deciding vote. Markets are expecting a tight 5-4 split among cuts versus rate stays. Money markets have priced in a 90% chance of a rate cut. Some policymakers, though, at the bank have signaled that inflation pressures in the country are well contained. Any signals regarding the bank's expectations for wage growth and other inflationary pressures will be closely watched. Notably, though, ahead of Thursday's meeting, we'll get jobs data on Tuesday out of the UK. It is expected to show an uptick in unemployment and declining wage growth. If realized, those factors could alleviate some concerns among policymakers about sticky inflation. Now, lastly, on Friday, the Bank of Japan is expected to raise rates by 25 basis points. Economic conditions in the country appear set for the bank to raise rates, inflation in the country remaining elevated, and notably, too, an expected rise in wages for the country in 2026. The Bank of Japan said that its most recent survey of companies showed that they do expect to raise rates at the same rate they did in 2025. This was a factor that the bank had said was necessary to happen in order for it to begin raising rates. Focus at the bank's meeting will center around any signals on the pace of or lack thereof future tightening. It is likely that the bank will stress that the pace of further rate hikes do depend on how the economy reacts to the initial increase in rates, though.
JP, economically speaking, domestically, what else is on the calendar for this week?
So this will be a busy week for data in the U.S. as well. A lot of stuff on the calendar. This could also help shape market expectations for monetary policy in 2026. Tuesday, we'll get November's non-farm payrolls report. That will be published, and most forecasts are expecting a gain of around 50,000 jobs for the month. That would put it well below September's 119,000, as October's report was canceled outright. Now, this report will be the first timely report we'll have on the jobs market and does come after the Fed lowered rates last week. Fed Chair Powell did mainly emphasize that the job market presents a greater risk to the economy than inflation does. On Tuesday, we'll also get delayed retail sales data for the month of October and housing starts for September. Out on Thursday, we'll get services PMI for data from S&P Global. As well as consumer prices data for November, where prices are expected to rise by 3.1% year over year. Core inflation is expected to near 2.9%. The most recent data we have on consumer prices did show that consumer prices were at 3% and core prices were at 2.9%. So Powell did note that the central bank does expect tariffs to have more of a pass-through effect on prices, and that inflation is positioned to move back to its target after moving through tariffs, although that's not likely to happen in 2026. Powell did note that if not for tariffs, inflation would be having an easier time returning to the bank's 2% target, mentioning that more than half of the source of inflation in the country is a result from goods related to tariffs. Looking to November's report, food inflation is expected to remain elevated due to higher meat prices as a result of labor disruptions and tariffs, while energy prices, medical services, and car insurance are also likely to lead to a slight uptick in prices. However, though, on a positive for consumers, rent inflation is expected to cool, which could help contain core CPI.
Thanks, JP. Mark Pullman, let's talk about cocoa. How is the West African crop shaping up?
All right, so we saw Ivory Coast port arrivals this week come in at 91,000 metric tons, and that was an improvement over last week. It was up from 85,000 last week and 75,000 a year ago. Cumulative arrivals now about 894,000 for the marketing year, which is close to last year's 895,000, but behind the 5-year average of 991,000. Having the weekly arrivals increase this week provides some sort of relief to those worried about this year's production, because this was after last week. It fell 15,000 from the previous week, and we had a slow start, but 7 of the past 8 weeks have been above average, last week being the exception. However, we got to keep in mind that last year's arrivals were the lowest in at least 5 years, so even keeping pace with year-ago levels will not get cocoa out of its current supply hole. Ivory Coast and Ghana are seeing more rainfall than normal for this time of year. This can delay crop maturation and harvest progress and slow drying times for harvested beans. But it could also boost production for later in the season. We have the Herman wind which would be arriving, coming down from the Sahara over the next month or two. If we have a strong wind this year, it does have the potential to damage crop for the new year.
And Mark, looking at the crude oil market going into 2026, what are going to be some key factors there?
Well, we have this expectations for oversupply hanging over the market now that could hang over the market into next year. Earlier this year, we saw OPEC Plus boost their, increased production significantly, very quickly. They've slowed down, but that is expected to come home to roost. We also have U.S. production run very strong. It's 13.853 million barrels per day last week. The record was 13.862 million, and that was set in early November. And there's also this possibility of a peace agreement between Russia and Ukraine that would open the door for the lifting of sanctions in Russia. We seem to see a little bit of movement in that direction over the week. Tentatively, a Ukrainian president agreed to drop the country's aspiration to join NATO. That was probably the easiest thing for him to do. There were low expectations for that to begin with, but there's still some key issues they have to work through that will be much harder, most notably Russia's demand not only to keep the Ukrainian land that they've already occupied, but take more as well. And there are also security concerns that Ukraine may need with U.S. and Europe, some sort of agreement. On the demand side, we have seen persistently strong refinery operating rates in the U.S. Last week, 94.5% versus a 5-year average of 88.9% for this time of year. And then there's the issue of Venezuelan oil and the possibility that the U.S. is planning to seize more tankers, which has the potential to amplify geopolitical anxiety. But so far, the market hasn't reacted very strongly. It was lackluster in the initial news last week, and that could be telling us that it's not that big of a threat or the market is running out of bullish juice. A bit longer term, we've got to watch Chinese consumption rates, and there's also support from AI and data center demand.
Thanks, guys. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.